What if I told you that silver could shock the world and race toward $1,000 per ounce before the summer of 2026 is over? Not because of hype, but because the charts are quietly setting a trap. Most people think moves like that take decades, but history shows that when silver finally breaks, it doesn't walk higher, it explodes. Right now, beneath the calm surface of the market, technical signals are stacking up in a way we haven't seen in generations. This is the gray ledger, where we follow the money, the patterns, and the signals most people miss until it's too late. If you want clear, no-nonsense analysis on what could reshape the financial landscape, take a second to like this video and subscribe, because what's coming next may redefine how you see silver forever. To understand why a four-digit price target is even being whispered by serious analysts, you have to zoom out far beyond daily headlines and look at the long-term structure. On short time frames, silver looks volatile and chaotic. But on multi-decade charts, it behaves like a coiled spring tightening over time. Every major bull run in silver history started the same way. A long period of frustration, sideways movement, and disbelief. In the 1970s, silver spent years going nowhere before launching into a vertical move that stunned the world. It drifted quietly for nearly a decade before climbing almost tenfold into the 2011 peak. The key detail most people overlook is not the spike itself, but the base that formed before it. Strong bases create powerful breakouts, and the longer the base, the more violent the move when resistance finally gives way. Today, silver has been forming one of the largest consolidation structures ever recorded in modern markets. Since the 2011 high, price action has carved out a massive multi-year pattern that technicians often describe as accumulation. Accumulation means strong hands are slowly absorbing supply while weak hands lose patience and exit. It doesn't look exciting while it's happening, which is exactly why most investors ignore it. But when the absorption phase ends, there are very few sellers left to slow the advance. Another critical piece of the puzzle is the concept of historical price floors. These are levels where silver repeatedly refuses to stay below, no matter how negative the news becomes. Over the past 2 decades, each major sell-off has bottomed at progressively higher levels, forming a staircase pattern upward. This staircase suggests underlying demand is strengthening even during bear phases, a classic sign of a long-term bullish structure. One of the most important floors formed after the 2008 financial crisis. When silver briefly collapsed and then snapped back with extraordinary force, that rebound wasn't just a recovery, it was a signal that deep-pocket buyers were waiting for panic to strike, so they could accumulate aggressively. A similar pattern appeared during the 2020 global shutdown, when prices plunged and then surged as liquidity flooded the system. Each crisis reset the market, shook out weak holders, and transferred metal into stronger hands willing to hold for the long term. Technical analysts often pay close attention to these panic lows because they reveal where true demand lives. When those lows keep rising over time, it indicates a tightening supply-demand balance that can eventually trigger an upside breakout. Another powerful signal comes from long-term moving averages, which act like gravity lines for price. For years, silver has oscillated around its 200-month moving average, repeatedly bouncing rather than collapsing below it. This behavior suggests that large institutional capital views those levels as attractive entry zones. When price begins to hold well above such a major average, it often marks the transition from accumulation to expansion. Momentum indicators are also beginning to shift in subtle but important ways. On very long time frames, oscillators that once signaled overbought conditions have reset without price making new lows. This divergence implies that downside pressure is fading, even though headlines still sound bearish. In past cycles, similar divergences appeared shortly before explosive rallies that caught most traders off guard. Volume patterns tell an equally interesting story if you know what to look for. Large spikes in buying volume have tended to occur during sell-offs rather than rallies, which is the opposite of what you would expect in a weak market. That kind of behavior suggests accumulation by participants who prefer to buy into fear rather than chase strength. Over time, these stealth purchases reduce the amount of available metal in the open market. When demand later increases, there simply isn't enough supply to meet it without sharply higher prices. Another overlooked factor is the psychological ceiling that has capped silver for years. Repeated failure near previous highs has conditioned traders to sell too early, creating a wall of hesitation. But once a market convincingly breaks a long-standing ceiling, that hesitation can flip into urgency almost overnight. Traders who sold early rush back in, while new buyers pile on, creating a feedback loop of momentum. This phenomenon is sometimes called a breakout cascade, and it can drive prices far beyond what fundamentals alone would justify. If silver were to clear its historical resistance with strong volume, technical models suggest there would be very little overhead supply left. In simple terms, not many people would be waiting to sell at slightly higher prices. That vacuum above the market is one reason some analysts even consider extreme targets plausible. It doesn't guarantee a move to $1,000, but it explains how parabolic advances can occur faster than anyone expects. Volatility itself can become fuel. attracting speculative capital that amplifies the trend. The final technical element to consider is time, not just price. Markets often move in cycles, and silver's major bull phases have historically followed long dormant periods of roughly a decade or more. By that measure, the current cycle is already mature enough that a breakout window could be opening. Whether that window leads to a modest rally or a historic surge depends on how multiple signals align in the months ahead. And right now, many of those signals are beginning to point in the same direction, quietly, steadily, and without mainstream attention. Beyond charts and indicators, there is a structural characteristic of silver that makes its rallies uniquely violent compared to most other assets. Silver is a relatively small market, meaning it takes far less capital to move the price, dramatically than it would for something like major stock indexes or government bonds. When large funds decide to rotate even a tiny percentage of their portfolios into silver, the impact can be outsized. This is why past bull runs have featured sudden vertical moves that seem disconnected from day-to-day news. Another key factor is that silver sits at the crossroads between an industrial metal and a monetary asset. When economic optimism rises, industrial demand supports prices, but when fear rises, monetary demand can surge at the same time. That dual demand profile creates conditions where both risk-on and risk-off capital can flow into silver simultaneously. Technically, this often shows up as rising price floors even during uncertain economic periods. A particularly powerful setup occurs when consolidation tightens into what traders call a volatility squeeze. In this phase, price swings become smaller and smaller, forming a compressed range that stores energy like a spring being wound tighter. Historically, silver has produced some of its largest advances immediately after such compression phases resolve to the upside. The longer the squeeze lasts, the more dramatic the release can be when the market finally chooses a direction. And now, long-term volatility measures suggest silver is trading far below the turbulence levels seen during previous breakouts. That doesn't mean a surge is guaranteed, but it does indicate the potential energy is building beneath the surface. If a catalyst appears while the market is this tightly coiled, the technical reaction could be swift, disorderly, and surprisingly large. One scenario analysts consider is a chain reaction, where rising prices attract media attention, which draws in retail buyers, which then forces short sellers to cover, accelerating the move even further. Short covering rallies can be especially violent because they are driven not by optimism, but by urgency and loss avoidance. As prices climb, each incremental gain increases pressure on those betting against the market, turning them into involuntary buyers. In extreme cases, this feedback loop can create vertical price action that looks almost unreal on a chart. However, it's important to understand that markets rarely move in straight lines, and even the strongest bull runs include sharp pullbacks that shake confidence. These corrections are not necessarily signs of weakness, but mechanisms that reset momentum and allow the trend to continue. Long-term investors often view them as opportunities, while short-term traders may interpret them as reversals. If silver were truly entering a historic expansion phase, volatility would likely increase dramatically, not decrease. Price swings of tens or even hundreds of dollars could become normal as the market searches for equilibrium. That kind of environment can feel chaotic, but it is often where the largest fortunes are made and lost. Whether $1,000 silver becomes reality or remains a distant dream will depend on how these technical forces interact with real-world events. What matters right now is that the setup exists, the pressure is building, and the window for a major move appears to be opening. If you found this analysis valuable, let me know your thoughts in the comments and share this video with someone who needs to see the bigger picture before the crowd wakes up. Conversations like these help more people understand what may be unfolding beneath the surface of the financial system. Stay alert, stay curious, and keep watching the gray ledger, because the signals that change everything rarely announce themselves in advance.